Welcome to Right on the Money, the weekly talk show with interviews you can use to help you maximize your money and optimize your financial future. Before moving forward with any of the ideas discussed on the show, always consult your financial advisor, insurance professional, or tax consultant. Looking for financial help or a second opinion? We can help you in your search. And now, your host of Right on the Money, syndicated financial columnist and money-colored commentator, Steve Savant.
In this segment, we're talking about how annuities are titled and taxed with Liz Cornell, author, popular platform speaker, and certified annuity specialist. You're also kind of a historian on this annuity stuff, I heard. Before we get into the title and tax issues, talk to me about this. I mean, somebody told me, I thought annuities were like, a couple hundred years old, and I think you told me off the set. Are you kidding, Steve? The Roman Empire started this 2,000 years ago.
Yes, annuities have been around, the concept of them, for thousands and thousands and thousands of years. It's just that the life insurance industry decided to get involved about 200 years ago, and now we have the product platform that we do.
Well, when I'm thinking about this, I'm looking at different things. I noticed that this Roman judge in 222 AD, 225 actually, he actually had some kind of a mortality table, for lack of a better way of explaining it, that helped Roman troops so they could actually have some benefits for their surviving families, for their wife and their children.
Yeah, it was basically a pension. The Roman Empire wanted to say, hey, thank you for your service. We've got some money here, and if you come and work with us, we will pay you an income for as long as you're alive.
I'm looking at this. The British Empire in the 1700s, the actual parliament authorized annuities, and it became very popular with European high society as a form of prevention from any fall of grace, economic fall of grace, or any hard times. That was always their underpinning no matter what else would happen.
Oh, yes. And it sounds kind of ironic. It was a betting pool amongst these upper elite aristocrats on whose money they thought they were going to get and who was going to die first. They all put money. They were private pools. Obviously, the life insurance industry wasn't involved at that time. And they all started taking an income payment based on their mortality, much like back in 225, how long we think everyone's going to live. And if somebody got promoted, I like to call it, they would pay out a higher income payment.
Okay, so we have a history here. This isn't something we invented in the 20th century. This has been around for a couple thousand years, a couple millennia, in some relative form or another. So let's talk about titling. I always think about this because this is an area where consumers have some bit of trepidation. We have the annuitant, we have the owner of the policy, and we also have the beneficiary of the policy. Kind of break me down what's going on here, because we want to be able to title this right.
Absolutely. And I'm going to take that a further step back and really see that the tax status of the money dictates how it should be titled. Also, your legacy you want to leave, how you want money to be distributed later, should be taken into consideration. So the annuitant is the live, breathing person. They are the ones that are entitled to the contractual guarantees for income, and it is based off of their lifetime. The owner is the entity or the person who owns the contract, owns the account itself. It doesn't necessarily have to be the live, breathing person.
Now, well, can I ask you a question on that? So the owner, policy owner, annuity policy owner, that's the person that's connected to the tax situation. Is that the way I understood that?
I would articulate that a little bit further and say that how it is titled, the tax status of the money should be considered. It doesn't solely dictate it, but to your point, with an IRA, right, individual retirement account, that is you. You're the only person who can own it. You and your spouse cannot joint own it because IRAs do not allow for that. So when I'm looking for titling, it could be my qualified plan. You're just bringing that up. That's another issue. I could have this in my qualified plan. Now, remember, I've heard people quandary, advisors go back and forth on this. Hey, should annuity be in a qualified plan? Should it not? What's your thoughts? I think it's one of those comments that makes me crazy, because if you get online and Google, there are just as many articles that say you shouldn't buy an annuity with IRA or tax-deferred money because the money is already tax-deferred, which really, to me, makes absolutely no sense. That has nothing to do with anything. An IRA, a 401k, a 403b, is already an annuity within itself. Okay. First and foremost, most people cannot access that money prior to 59 and a half already. So you've already got rules on how it is you're supposed to take that money out. Now, after 59 and a half, you can do what you want to with it. If you're not taking from it, though, at that time, the IRS says that at 70 and a half, you have to start taking distributions. You have to start whether you want to or not. That's basically what an annuity is. It is tax-deferred money. You have to start taking out at some point, which you have to do with an IRA anyway. And most people feel that within an annuity, well, I have all these rules for how I have access to the money. Well, you already have that anyway. IRAs, qualified retirement plans, 403bs, 401ks, are some of the best money to put into an annuity because you're already leveraging what you have to do.
When I'm thinking about qualified plans, especially when you said 70 and a half, I'm thinking of all of the seniors that are sitting here knowing that, hey, listen, I have to take mandatory required minimum distributions at 70 and a half. If I don't, we're looking at some serious penalties.
Oh, yeah, absolutely.
So I have to match up my annuity with that 70 and a half to make sure that my required minimum distributions are going to be matched up with the annuitization if I use that tactic.
Sure, and you don't have to do that. A lot of times with folks, for the planning that we do, let's say that you have an IRA, and yes, you have to take this requirement of distribution. So you can take a portion of that money, and within the contractual bounds, guarantee that that requirement of distribution is always going to be there, whether the payments supersede what you initially put in. A lot of times you can guarantee that that income is going to be there for your spouse, even if what they take out supersedes what you initially put in. Then you can take the rest of the IRA and go invest it in whatever else.
Okay, so if I have multiple contracts, usually I've seen some annuity companies actually send you the RMD, the actual, here's your number off your actual annuity if that's the only thing you have.
Yes, you get a fair market value statement at the end of every year that says, hey, this is what your IRA was worth on December 31st of previous year, and that's what the IRS uses to say, hey, here's how much money you need to pay out the next year.
I've heard you talk about this little kind of a side issue because we're talking about when you're titling an ownership. I'm doing it for my beneficiary. I'm the annuitant, a live person, as you've said before. I'm looking also, beneficiaries. I want to have this go into perpetuate, into forever and generation after generation. I know you went to Ed Slott's university. He's really a sharp guy. I heard you can bump this out you could actually have some owner or beneficiaries that could go into your next generation.
Yeah, it's a stretch IRA. It is certainly something on the forefront right now that, depending on what the government does, may or may not be there for the next 100 years. But yes, they can take that IRA money, which is tax-deferred money, right? It's money we've never paid the taxes on, and your kids can take that money and continue, yes, depending on how old you are when you get what I call getting promoted. They may have to take requirement distributions for their lifetime, but they don't have to pay all of the income tax on it at once. They don't have to pay it in a lump sum. They can do a beneficiary or stretch IRA.
Okay, now when we're talking about taxes, and I always think about qualified money, there's no basis left. Once it's in there, you're paying ordinary income tax at whatever your effective tax bracket is. So that's pretty straight up. But if I have non-qualified annuities, right? Well, I got some basis play here, and I've noticed an anomaly that doesn't happen with hardly any other product, which is if I annuitize that, they kind of give you part of your basis and part of your earnings at the front end.
Yes.
I've never seen that before. Most products, it's LIFO, last in, first out taxation. You can't get your basis until later.
Yes, and if you do an actual true annuitization, non-qualified money is like what you have in a checking or savings account. They don't send you a 1099 and say, hey, you took $5,000 out of your checking account and you have to pay taxes on that because you've already done that. So within an annuity, when they distribute the money back via an annuitization, they pay you back some of what you initially put in, or what's called your cost basis, and a little portion of that payment is interest. And so you're able to spread it out over a longer period of time, and in that case can ultimately end up paying a smaller amount in taxes and end up netting more to yourself over time. I mean, at the end of the day, taxes are the name of the game. How much money am I netting? It's great if you have a $5 million IRA, but that's not all your money. You're going to pay taxes on it at some point. Somebody else is going to pay taxes on it at some point. That is not all your money. So it is important to be mindful of when you are taking this money out and distributing it back to yourself, how much am I actually netting? And using non-qualified money via the provisions within an annuity contract that take that interest and spread it out, you can end up netting more to yourself over your lifetime and or someone else's.
Well, it's a very big consideration for our clients that are listening today, our customers that are hearing us out, that, you should have a little bit of tax diversity. You'll have your qualified plans, which are going to be taxed. There's no basis left, as well as having non-qualified monies. And I love the annuity idea, especially because if I did annuitize it, I'm getting my basis, which is unheard of. Part of my basis is coming back to me every year until we recapture it.
Yes, and the interest grows tax deferred. So let's say you didn't want to do an annuitization, that you fall in the category of, I want to purchase an annuity with some money that I have sitting in a CD because I want to earn more interest, right, than what the banks are paying, which is basically next to nothing.
Right now,
even in that case, the interest grows tax deferred. So unlike a CD where you get that 1099 $1.99 every single year, whether you take the interest out or not. That interest grows tax deferred. So even if you don't want to do an annuitization, that's not your objective, you're just looking for somewhere to put money, an annuity is a great place to do that because the interest that you pull out is not taxed until you start taking it out.
Well, remember, if you're listening to our show on radio, iTunes, or a podcast, you can view our video version online at rightonthemoneyshow.com and request information from this segment. Well, that's our show for this week. I want to thank Liz Cornell for being my guest. But before I go, remember what the good Reverend John Wesley once said: make all you can, give all you can, save all you can. I'm Steve Savant. We'll see you next week right here on Right on the Money.
For more information on this week's money topics, just go to our website at www.rightonthemoneyshow.com and follow Steve's daily postings on Facebook, Twitter, and LinkedIn. When it comes to retirement, money management, small business, insurance coverage, college funding, or budgeting, we have the interviews you can use.